Hey everyone, this is Robert Keens with goldsilverpros.com. It is Tuesday, September 29th, 2020. And I wanted to get into the market report for gold and silver, as well as going over a Bloomberg article that came out yesterday talking about the scheme that JPMorgan has been using to influence the precious metals market. A lot of detail there that I think is going to be very, very interesting for those following that saga of the bullion banks manipulating the precious metals market. We'll get straight into the screen share here and looking at the price on goldprice.org. It is about, I want to say about 3:15 p.m. Central Time Tuesday. So as of right now, gold is trading up about $18 on the day. It's retesting that $1,900 high that we saw in 2011, which is a very positive sign. Silver's up to 24.22, and it'll be challenging that 24.50 critical support and resistance line that I've been showing you guys for the last couple of months. We'll get into the charts here. As you can see, gold is still in a major uptrend since about the last part of 2018 when it started to come up and form this bull pattern. It started to come down and challenge the $1,900 support resistance line from the last bull market here, and also went through the 50-day moving average, you can see, to the downside, but did not cross the 200-day moving average before it started to come back up towards 1900. That's a positive sign for gold, meaning it's possible we're at the end of this sort of bearish leg here in the middle of the big bull market that we're in, but it's still possible it could fall back down. It could re-challenge this 50-day moving average and come back down maybe further to form that cup and handle I've been talking about. We don't really know, although it looks as though trading is going to be very interesting until the December contract when we have a lot of open interest in the futures market. Let's go to a 3-month chart here, and you can see what happened. After gold got up to almost 2070, it started to fade and range trade a little bit, and then finally crashed through the 50-day moving average as represented by this blue line, and then this support level, the $1,900 one, which was the top in the previous bull market in 2011, came down but did not touch on the 200-day moving average as represented by this red line. So that's a positive sign. It's up trading, bouncing around this $1,900 number. Now, what typically happens when you had a bear leg down and it's retrying a previous resistance level, it'll bounce off, come down, and come again. So we might see that type of action. I don't know if it'll come straight through, but we'll see what happens over the long term in gold. But so far, a positive note today that we're having an uptrend in gold. And again, healthy volume down here, as you can see on the chart. So a lot of trading going on. Let's look at the gold volume. You can see healthy trading, 252,000 contracts for September 28. Most of that's going to be in December. Some of that could also be in October and November. Healthy volume for December of 235,915. So the rest of that 252 is probably in these other contracts here, maybe a little February, maybe a little October. But that's a lot of trading. And so it looks like there's been some healthy long action going on in the volume. A question I got from a couple of listeners and readers of my stuff is, what are the active months where you can take delivery and you can trade? So I wanted to show you here, if you go to the CME Group's website and you click on, we usually click on volume, but if you come over here and click on calendar, it'll tell you the tradable months. It gives you the contract month, or about 6 a year for both gold and silver. It'll tell you when you can trade. So you can trade during that month, but for example, September, you could start trading 30th of June. For December, you could start trading the 31st of December, 2014. And then you can take positions here, and then this is when you can take delivery. You can only take delivery during the contract month, but you can trade the futures, the paper positions, previous to that. And this column here on the calendar tab will tell you that for both gold and silver. So I just wanted to point that out in case you had questions about how many times can you trade a contract during the year, when can you take delivery, what are the dates, when can you get into a futures position for that month, for example, December, where we have all this volume. All of that information is right here on the calendar tab, okay? So a lot of action going on in gold. You see some positions closing out of October, and you see some rolling into December. Probably about most of those 3,000 probably rolled in. We did for September. We're still seeing some deliveries, more deliveries. There was a change in open interest, so still contracts being posted during the spot month. So not typically a futures contract, but what I call a shadow contract or spot contract. And you see that when the delivery numbers are higher than the open interest. Somebody's coming in and they're doing an immediate delivery contract. Wanted to move over to silver really quickly. We had a retracement in silver as well. So both gold and silver retraced at the same time. Silver crashed back down through these critical support lines. You see this is a support line here from the last bull market. It hit 4 times, I count on there on that chart. around the $26.50 mark. Then it crashed through the 24.50 support line and through the 50-day moving average. You can see this blue line here, 50-day moving average, down to about 23.60. Actually, right now it's up to 24.22. So it's coming back up to challenge this 24.50 line. So let's look at a short-term chart for silver, and I'll explain what all of that means. So when it peaked and almost hit 30 bucks, it came back down to this 26.50, this major support line, tested it a couple times, went up, and then eventually fell back through. This is normal trading activities. When you see a major support or resistance line, you'll bounce around it a couple of times, and then the market will make a decision. It made a decision to go short. It shorted through this 50-day moving average price, and it went through the critical 24.50 line, but it bounced before it hit the critical $22 trading line, which I thought it could. I thought it could, get to the 21, 22, or it could bounce again. So it's had a little bit of a bounce, which is nice. And that's also bullish for silver on healthy volume, because we're going to see here in a moment when we look at the volumes, there is healthy volume in silver. So the total volume on September 28th for silver, if we can get it to show, is 80,493 contracts. 78,578 were in the December contract. Some of the rest will be around these other contracts. 78 came off of the October contract. 959 came into the December contract. 203 came into the March contract, and so on and so forth. And there's about a 35 change, it looks like, into September, positive into September, people trading the near month, again, spot contracts. So expect some deliveries there when they come in the spot month, and you have a positive number in open interest. So that's going on with silver. So it's nice to see some positive movement in gold and silver after the bearishness. Does that mean that we're not going to have the cup and handle in gold, or a larger retracement in both gold and silver down before we have the next big leg up? I don't know. I'm still looking for that cup and handle. Cup and handle is a very bullish pattern. So if it does form, I wouldn't panic. It means we're probably going to have the next big leg up. So I wouldn't worry too much. Another way to look at the commitment of traders report, if you guys remember, you go to the CFTC website, you can see the commitment of traders. And for those of you who have not been following the series, it shows you the total amount of open interest in a market. This is palladium, but it does for all the precious metals. And it breaks it out into categories of users. Here you have producer merchants. So producers are the ones that dig it out of the ground. The merchants are the ones that use it to make finished products. The swap dealers are the bullion banks. And they typically are large short, as you can see here. The managed money, which typically large long and behind the trade, usually lose money on the trade. And the other reportables are like wealthy individuals, trusts, and those types of things. So this report, you get it about every week. This is for September 22nd, 2020. So that's looking back, everything up to September, or as of September 22nd, 2020. You can see for all of the metals, here's silver here, here's gold here. And you can break it down into categories. You can see who's long and short, what percentage change position did they have, which is, this is a total change position they had, and here's the percent of total open interest. All of that's there for you. But there's another cool way to look at that over at bar charts. So you can look at both gold and silver on bar charts for free. You don't have to have an account for this. And I'll put a link to this bar chart COTS data for you in the description. But it's really cool. You can see, here's the gold. In this case, we're on the gold contract, the gold price here. You can see over here, this on my left of the chart, you're going to see this yellow box pop up. And this is the COTS data for that week. Now, if I move back to this other candlestick, I'll get it for the previous week, the 21st. If I move forward, I get it for the 28th. And as you read those numbers, COT LC, parentheses L, parentheses S, C, P, S, M, and O, those correspond to the different groups that you see here on the COT report. And I'll show you that on the chart. So as you look at the chart, the large specs are here. That would be the COTLC, parentheses L. This would be the COTC, parentheses S. This would be the COTC, parentheses C. And then the last four positions are down here. The COT DLC, parentheses P, are the producers, parentheses S are the swap dealers, M is the managed money, and other reportables. So as you go over here to the edge of the chart, you notice that the producers are net short, negative 93,037 contracts. The swap dealers, negative 173,000. The managed money, positive 81,448, and the other report is positive 137,612. If you go over the commitment traders report, those numbers line up. I was in gold, so let's get down to gold real quick. You see those numbers right here, 113,771, 257.04. So those numbers match up with here, but it's a net. So you take the 113,771 minus 2734 on the chart, and you get the number over here, 93,037 for the producers. So in other words, it's taking the aggregate position that you see in the COT report. But the cool thing is this gives you a little bit of history of what's happened over time. And I like to pay attention to this bottom little graph here, which shows what happens when the price of gold or silver rises or falls. So for example, let's take the producers, the red line. When the price of gold is rising, they're going short. They're shorting a potential fall in the price, and vice versa. And they play the price depending on what they think can happen. So as the gold price rises, they were starting short and then realized, well, the gold price is rising. We need to reduce our shorts. We don't need as much short exposure because the price is rising. It's moving in our favor. But some of the merchants are in there as well. So producers and merchants are kind of put together. So the merchants, when the price rises, they'll want to take a long position because that price is an input to their final product. It's a cost. The producers, it's revenue. So if the price is going up, they'll reduce their shorts because they don't need as many shorts to hedge that price because the price is moving up. It's also nice to see what the swap dealers do. The swap dealers are really sharp. They trade along with the price in gold and silver, and they take the positions. They're the ones that make the money. The managed money, the blue line here, they're always opposite of what's going on. When the gold price is going up, they go long. When it's short, they start to go short, but they always lose money. They're always behind the trend. You can see they're always behind the trend. So you see basically a move down here in the price of gold, and you see them catch up with the movement, but they're always a step behind. So I like to say the managed money are basically the patsies at the table. They're the ones that probably lose more money on their trade than anybody else. And it's the swap dealers and other reportables that basically take advantage. That's typically what happens. But if you want to trace what's happening over time to the different commitment of traders, what the traders are doing, more than just in this weekly chart that I've showed you, go to barchart.com and you can see it in gold. And I've got the silver one right here as well. Here's the silver contract. And you can see the action of all the different traders broken out into these 4 different colors, as the price rises and falls. And after a while, you read that chart for a while, you start to see who's making what bets when the price moves up and the price moves down. And you can tell who's basically, shorting the market, who's going long the market, who has the largest position in terms of overall contracts. Of course, you see the swap dealers always have a large position. The managed money always has a large position. The other reportables are wealthy individuals. They stay really close to zero. They just kind of go up and down as needed. And they're basically the smart money. They don't get too long or too short. And I think managed money is the other reportables, this yellow line, is taking a lot of physical off the market. That's why they don't have a lot of futures positions. They'll go long when they want to take the metal off the market. And you see they go long a lot of times. You have the short move. The short move here, they went long, net long right here. They're taking physical off the market. So I think the other reportables are the smart money. The managed money tends to be the dumb money here. And you can kind of see that on the chart and see what's happening overall. So I just wanted to show you that. Now I want to go to the commitment traders and show you what's happened in the last week leading up to the 22nd. So this is through the 22nd in gold. You see an overall closing of 3,048 open interest overall for all the near-term contracts. Positions, you see net, the producer merchants dropped 7,000 short positions and went long 1,000 in gold. So they're going net long almost 9,000 contracts. They're expecting the price to rise. The swap dealers dropped 7,000 shorts and went long 26. So they're expecting the price to rise. The managed money dropped 21,009 and went the opposite way, 77.49 short. They're expecting the price to fall. So if you're betting on the gold and silver price, you'd probably side with the producer merchants and the swap dealers and against the managed money. So this could be a bullish sign for you. The fact that managed money is going net short usually means they're behind the trade. And of course, we saw the price pop. Remember, that's last week's data we're seeing on the COT report. And you see the price pop this week, they're always behind. That's why I say the managed money is always the losers. Then the other reportables are going net long as well. So they expect the price to rise. So the other reportables, swap dealers, producer merchants, called in their futures trading, they called a little bit of the gold price recovery and the silver price recovery that we're seeing this week. And you can see that in the commitment of traders. Same thing here with the silver. Net, 4,400 silver contracts were closed, a 5,000 ounce silver. Net, you had the producer merchants going along about 3,500 contracts. The swap dealers were going net short about 900 contracts. The managed money was going short about 2,800 contracts, and the other reportable. So we're going net long about 3,200 contracts. So again, most people expecting silver to rise, except for the managed money, which is on the opposite side of the trade, and net about 2,800 contracts short. They're going to be the ones to lose because, as we see, that was last week's data, and now this week we see silver rising. So rising silver environment, managed money tends to lose. Again, they tend to be the patsies at the table most of the time, and most of the managed money position loses money. So that's your trade report for today. Now I want to get into the really juicy stuff. We're going to talk about JPMorgan. The last video I did talked about the $1 billion fine that they got for allegedly, I have to say allegedly because they didn't admit guilt, but allegedly manipulating the precious metals in the treasury markets. And that was reported on Bloomberg as well as some other spots as well. And so I think they got out of it. We don't have to admit we're doing it, but we'll pay the $1 billion. A person that is very experienced in the market, we had a phone call this week, and he basically told me, and not only is he experienced in the market, he was a trader and also the chairman of one of the exchanges. And I can't give away who it is because I didn't get permission to do that. But he basically told me that essentially he thought the market was fairly traded now. And, you know, he didn't believe in the large manipulative position of a lot of the bullion banks. And again, they didn't admit guilt. So I'm not sure I believe that with a $1 billion fine. But again, you know, without an admission of guilt, how do you prove it? Well, the cool thing is Bloomberg has come out with a report on exactly how it happened. So, and I had a PDF this because if you spend any time on their site, they'll lock you out unless you create an account. And I don't want to create an account. So this came out on September 29th. I'm sorry, printed on September 29th. It came out on 28th by Tom Schoenberg. This is a PDF of the article, and it's called Inside the JPMorgan Trading Desk. The U.S. called a crime ring because sometime back, the Department of Justice called it a crime ring. And they're talking about how it works. So they're highlighting one guy called Mike Nowak. He led the global trading desk at JPMorgan for a long time, and they're a powerhouse in gold, silver, platinum, palladium. Of course, you know that JPMorgan stores hundreds of millions of dollars worth of stuff on their individual depositories. So this is basically outlining how Nowak and his desk basically spoofed the price of precious metals, manipulated them, and made millions and millions and millions of dollars. Others from the precious metal desk provided accounts setting off events leading to criminal charges against Nowak and 4 others from the bank. Testimony by Edmonds and other also underpins U.S. Justice Department criminal investigation. The bank itself, that people familiar with the matter say will be resolved in coming days. They're expected to pay $1 billion. Another reference to this $1 billion from the Justice Department and U.S. Commodities Futures Trading Commission. So Nowak and 3 others have pleaded not guilty and are seeking to have the charges against them dismissed. Lawyers for them declined to comment. Prosecutors are testing an unusual application of law formulated to battle mobsters, the RICO Act, the Racketeer Influenced and Corrupt Organizations Act. Prosecutors say Nowak's trading desk was a criminal racketeering operation within the confines of America's biggest bank. Traders on Nowak's desk at JPMorgan engaged in spoofing as a core business practice, doing it more than 50,000 times over nearly a decade. So that starts to outline how long they were doing it and how much they did it, for those of you asking. The Justice Department formerly has famously used the RICO statute to bring down mafia bosses and drug gangs and against guilty pleas from big banks accused of market manipulation, but it's been decades since the government has attempted to apply it to a major bank's trading desk. In other words, like trading commodities, for example. They go on to, this article goes on to talk about Bear Stearns. Now, before I talk about Bear Stearns' link in the article, if you go over to Chris Marcus' site at Arcadia Economics, he did an interview with Bart Chilton, the former commissioner of the CFTC, the Commodities Futures Trading Commission, the regulatory body for the exchanges. And Bart Chilton went on to admit that JPMorgan took over Bear Stearns' positions in the silver market when Bear Stearns went belly up. And they had positions greater than the allowable limits, the position limits on the exchange. They actually increased them. The CFTC said, hey, you got to stop doing this. You're over your position limits. You could be unduly influencing the market. That's what position limits are there for. And eventually they got them to come off of it, but JPMorgan actually increased from where Bear Stearns were overall. So that's key to note when we're tying together the position, the short position, which used to be held by Bear Stearns until the last financial crisis, and then JPMorgan took it over and then actually increased it beyond the allowable limits, and the CFTC had to warn them. This is all an admission on Chris's site in the interview with Bart Chilton. If you just search for Bart Chilton at Arcadia Economics, you'll find it. It's a great interview. You should listen to it. So they're talking about the history here of Bear Stearns. It said Nowak had just completed a swift climb at JPMorgan. He joined the bank's trade from Duke University and traded options for a few years. He was 32 years old when he took over London and Singapore operations, and the financial crisis expanded his his remit, basically. JPMorgan's takeover of teaming Bear Stearns meant Nowak's group would absorb Bear's precious metals desk and some of its traders, including their massive short position. Bear traders worked in Midtown Manhattan, just across Madison Avenue from Nowak. So they were trading, on Wall Street close to each other. The Bear Stearns was 2 days from closing on May 27th. Nowak was still getting to know his future employees. And then they basically took on the employees. But the Wall Street Journal ran some trading information. So Greg Smith was at Bear Stearns and he executed a trade over a 15-second series of keystrokes. It's interesting what he did. He entered an offer to sell 7 contracts at a specific price, 17,575. So he's putting in a sell order. Then he places 13 more offers to buy, not to sell, but to buy 91 contracts, 91 total contracts. So an offer to sell 7 contracts and to buy 91. So he's going more long than short. There were prices from 1755 to 7565, just below his unfilled sell offer. That way he wouldn't be filling his own offers with his own buys, in other words. Within less than 0.7 of a second, Smith begins to get buyers for 7 contracts start canceling the buy offers, his 7 futures contracts. So he's getting a buy on the sells, then he's selling off or closing his buy offers. And then Nowak received an instant message from Bear Stearns' manager across the street, the manager of Smith, and says, Smith bid it up just to sell. So he's bidding it up with a large amount of contracts so that he can then sell at a profit later. That's basically the scheme, and that's called layering. This article goes on to describe layering. What was happening was they were having troubles with algos, which is down here. There's algorithms or computer algorithms that see trades come in, and they'll trade based off of that very quickly. Well, they wanted to manually put in trades to take advantage or to manipulate the market. So they would have to layer in the trades over time to kind of fool the algos into doing something. And once the algos reacted, then they took the other side of the trade. That's basically how they're documenting this worked. And this was to control $600,000 worth of silver futures change hands in just that one instance. And they go on to say how many times this happened. So some of Nowak's traders were attempting to counter. I was playing a single large order, and that broke on them. So they would start layering in. And the layering worked in futures markets in part because the participants see a second-by-second barrage of offers buy and sell, but not who's making them. That's the key. When it's in the market, not who's making them. So you can't see that one person may be entering buys and sells at the same time and potentially manipulating the market. All people see on the screen is buys and sells coming in. So going on here, more stuff. Okay, Smith, a lead gold trader, executed some 38,000 layering sequences over the years, or about 20 a day, prosecutors said in filing. Nowak himself primarily traded options, but he would dip into the futures market to hedge his positions. He tried his own hand at layering in September 2009, according to filings, and went on to use the technique 3,600 times, which helped bring in $250 million in annual profit into the trading desk there at JPMorgan. Of course, JPMorgan traded other things, but it was part of that $250 million profit. So now you're starting to see numbers of times this occurred and the amount of money that would get affected on a yearly basis for JPMorgan, how they would make money doing this off their trading desk. Then they went on to say that he would train other people. One of his acolytes at the desk was Edmonds, and he would train him basically to do the same thing. Screening for spoofs. So what happened was the Justice Department started to get wise to say, well, we can't tell exactly who's doing what, but we're going to develop a pattern or an algorithm to detect patterns. And that's what they did. And that's what this part of the article is about. I'm going to read this paragraph starting right here where it says, Perry also had a valuable gift to the market. His lead FBI investigator, Jonathan Luca, previously worked as a gold and silver future market at Morgan Stanley. Perry's the guy that's looking for the activity. Together, they created a screen for precious metals trading data. This is key. This is how they caught him. The idea, according to 2 people familiar with the analysis, was to turn up sequences in which a trader placed and canceled a profusion of orders, in other words, layering to affect the price, on one side of the market while executing a trade on the other. The bigger the mismatch between the genuine and pulled offers, and the more a given trader did it, they said, the more it'd be considered a red flag. So the more time they're putting in one side and then putting in the other and then pulling the one side off to influence the price, that would raise alarm bells. And the more times a day, the more overall times they did it. And when they ran the screen, JPMorgan stood out. In other words, it's pointing, using the trade data, pointing back to JPMorgan. This is where they're starting to get into those transactions that I talk about. When I look at the CME Group data, I don't have access to these transactions. When they're analyzing the market, these guys at the Department of Justice, CFTC, had access to the transactional data, and that's how they caught them. Remember when I said, if you put an auditor inside the CME Group and look at their data, you can catch what's going on. Well, that's exactly what the guys are doing. The FBI investigator, Department of Justice, it's what they're doing. And that goes to prove the point that if you have audited records, you can see this activity. And that's what they're doing. They're getting access to these records. So at the time, it goes on to say how many times he did it. At times, he placed orders with as many as 400 contracts on the opposite side of a genuine right here. And I think it says he went on to do it about 50,000 times, although I can't find that number on this screen. It says he went on to do it about 50,000 times. So they're basically putting RICO charges in him. Nowak appeared in handcuffs in federal court, New Jersey. They're putting him through the ringer. So this goes on to talk, this article is great at Bloomberg. Inside the JPMorgan trading desk, U.S. called a crime ring, September 28, 2020. I'm going to save this PDF. It's by Tom Schoenberg and his other contributors here at the end of the article. I'm going to go down here to give you those contributors. Joe Doe, Jack Farchi, and Mark Burton. So those 4 guys did all of this research. And that's how they got caught manipulating. And that's why the $1 billion fine came about, because they just looked at the trading data. They saw this anomalous activity. They saw how you can make profits. And they had all of this admission from people that used to trade. They linked together the Bear Stearns silver position with JPMorgan, how these guys did it. And again, like I told you, if somebody can audit those records, you're going to find the malfeasance. Well, they found it. The funny thing is, the article goes on to say that the CFTC investigated the same thing. The regulatory agency over these markets investigated the same thing 3 times and found nothing. You can read that in the article. You get a couple of guys who aren't experts, you know, or the FBI, Department of Justice, and they go in there and just develop a simple pattern recognition scheme, and they find it. And then the fine comes out for $1 billion. Okay, so what the hell is going on at the CFTC? I don't know. I think it's a captured agency. I don't think if you have experience in markets and you have access to the data, you can't find this. When you get some guys that, you know, just are, you know, are basically, you know, the cops come in and find it. You can't tell me CFTC couldn't have seen this. I mean, that's ridiculous. So that not only points to JPMorgan for manipulating the markets and how much it happened and how much they made off of it, but it also shows that CFTC is basically ineffective. Remember my previous video where I showed the research from Jerry Markham showing that the CFTC was ineffective. The CEA, the Commodities Exchange Act, was ineffective. They created the CFTC in '74. It was ineffective. Jerry Markham had that in his paper, remember, at Yale Law. And then now we're seeing the Department of Justice, the FBI say the same thing about JPMorgan and saying, you know, the CFTC didn't find it, but we found it, running a basic screen off of trading data, just a basic screen. Didn't require any super forensic investigation, just a basic screen found this behavior. So again, CFTC ineffective, CFTC ineffective, CFTC ineffective, regulators ineffective, captured agency, probably working for the banks ultimately at the end of the day and not for the people of the US or the people trading the market. Just wanted to point that out. I got one more delicious bit for you. Back in 2012, Blythe Masters had a CNBC interview in which she basically gave an interview to CNBC, was talking about whether or not they manipulated the desk. So I'm going to share that with you here in a second. I'm just going to go back and make sure I have my sound enabled. And we're going to go back and share this interview with you and talk and listen to Blythe Masters, who was the head of the commodities trading at JPMorgan 2012, basically say how they didn't manipulate the market and they were only serving client interest. The key thing is they weren't serving client interest. They were working for their clients, or basically the clients that came in to hedge positions. I'm going to show you where that's a load of bunk here in a minute, but I want you to listen to what Blythe Masters says in this interview. And basically, I think she's caught lying. Because remember, the Bloomberg article says over 10 years, that would be back to at least 2010, but they were actually documented to 2008, 2009 when they took over for Bear Stearns, and how Bear Stearns was doing it prior to moving over to JPMorgan. Then Greg Smith moved over to JPMorgan, and they did it at JPMorgan. That was during the time at which Blythe Masters was heading up that division of JPMorgan. And listen to her basically lie on this interview, where either she's lying because she doesn't know and she has the wrong information, or she's lying and she does know. We don't know whether she knew, but in fact, she's not telling the truth. Let's listen to that interview.
Is that really sustainable?
Well, we've been investing in the commodities business, and it's important to realize that our commodities business is not about betting on commodity prices. It's about assisting clients in executing, managing their risks, ensuring access to capital so that they can make the kind of large long-term investments that are needed in the long run to expand the supply of commodities. And that is an area which we anticipate will continue to grow very, very rapidly over the next couple of decades, in fact. So yes, we are very excited about the prospects for growth in this particular area.
And you're looking at growth not only in agriculture and in metals and in oil, but across the board in all facets. That's what you're investing in. A lot of concern has been placed, though, about JPMorgan's, particularly its positions in the metals space. And looking at your positions in silver, we talked earlier about the volatility in the silver market. Can you talk about JPMorgan's positions and price volatility, and how are they related?
Yeah, that's a great question, and you're right that there's been a tremendous amount of speculation, particularly in the blogosphere, about this topic. And I think the challenge is that speculation represents a misunderstanding as to the nature of our business. As I mentioned earlier, our business is a client-driven business where we execute on behalf of clients to achieve their financial and risk management objectives. The challenge is that commentators don't see all of that activity simultaneously. So just to give you a simple example, we store significant amounts of commodities, for example, silver, on behalf of customers. We operate vaults in New York City, in Singapore, and in London. And often when customers have that metal stored in our facilities, they hedge it on a forward basis through JPMorgan, who in turn hedges itself in the commodity markets. If you see only the hedges and our activity in the futures market, but you aren't aware of the underlying client position that we're hedging, then it would suggest inaccurately that we're running a large directional position.
Yes.
In fact, that's not the case at all. We have offsetting positions. We have no stake in whether prices rise or decline. Rather, we're running a flat or a relatively matched
So
book.
it's not, because what is commonly out there is that JPMorgan is manipulating the metals market, and from what you're outlining, that is not possible because of the different sides of the business that you're a part of.
That's right. It's not part of our business model. It would be wrong, and we don't do it.
You've had such a long history.
Okay, so there we go. We have the testimony by Blythe Masters, who ran that for JPMorgan, that they didn't manipulate the markets and that they had offsetting positions. Well, that's easy to refute, because if you look at the CFTC data, one of the things she said was that we help the producer merchants who want to hedge their positions. So remember, this is swap dealers. These are bullion banks. They have their own positions. So do the producer merchants. If you look at the amount of positions that they carry, it's relatively equal to the production of that commodity in a given time frame, 2 to 3 month time frame. So yes, some producer merchants may hedge through the swap dealers. They may be clients of JPMorgan's and all these other bullion banks, but they do enough hedging here that you shouldn't see large hedging positions over in the swap dealer. So let's look at producer merchants in silver. There are 56,327 shorts, which makes sense because most of the producers want to protect against downside price risk. Some of the producers upside price risk. So there's a lot of positions here in the producer merchant category. Why then would the swap dealers need all of these positions if they weren't running their own book, if they weren't trying to determine the direction of the market by trading the futures positions? We already have, the hedges here in the producer merchant category. Managed money does their own hedges against other positions they may have elsewhere in the metal. The wealthy families do as well, and the trust funds and those types of things. Why the swap dealers need some of the largest positions? They own 25% of the longs in silver and 28% of the shorts. Okay. Why do they need such a large position if you already have, all of the short? Look, 35% of shorts for the producers is already here. You don't need any more short positions. The swap dealers aren't doing it for legitimate hedge risk, which is only producers and merchants really, or financial hedge risk, which is like the managed money. Legitimate production of the actual metal, this would be like a derivative hedging risk in the managed money for positions in other markets. You don't need the swap dealers to have this type of position in either silver or gold. Same thing in gold. We're going to come down here to gold. Producer merchants have a massive amount of gold, long and short contracts to hedge their positions. Why do the swap dealers need so much? No, I'm sorry, Blythe, that's not a valid point. Yes, you are trading for your own book. You have to be, because the people that you say that you're hedging for your clients already have their own positions in the damn market. So that doesn't really make any sense. So at the end of the day, it's pretty clear that JPMorgan was not just allegedly, but pretty clearly, if you look at the data, manipulating the markets. They got fined $1 billion. If they were making at least $250 million a year, does that fine equal the amount that they made? No, because you're talking about lots of commodities markets. They got $1 billion for the precious metals and treasury market, but they're trading a lot of commodities markets. How much money did they make? And also, if they're taking possession of the physical as well, how much money are they going to make on the actual physical position? Or if they're making deals to get the physical to somebody else, if they're shorting the market and somebody else is getting the physical through their long contracts, are they making some money on the side through some other type of agreement which doesn't show up and the precious metals desk. I mean, there are all sorts of ways that you could think about they can make money from shorting and spoofing the market, like it was detailed in that Bloomberg article. So I think it's clear more and more data is coming out about JPMorgan. Now we're picking on JPMorgan. I'm sure others are doing as well. Scotia recently got fined 127.8 million, something like that, for doing the same thing in precious metals. So at the end of the day, it wasn't just JPMorgan, but that's how it occurs. It looks like some of the research has come out. Just like I said, you get an auditor in there to look at the actual transactional data, you'll find it. And that's what happened. Let's go back to share screen again. That is exactly what happened in this Bloomberg article. They got some guys in here that had some gold and silver experience. They ran a simple filter, looked at who was putting in trades and withdrawing one side and trading the other, how many times a day they did it. And basically it all pointed to JPMorgan. Not to say JPMorgan's the only player, but they were by far the biggest. Again, that's why you want audited reports. You want independent audits, and you want an agency, unlike the CFTC, who's actually effective. CFTC was ineffective. That's what the research I showed earlier told you. And the fact that the CFTC investigated, you can read it in this article, the fact that CFTC investigated this 3 times over the last 7 or 8 years and came up with nothing, when you have basically Department of Justice, FBI catch it, the first time they went through it, means that either CFTC is a captured agency and they're not legitimate, or they're buffoons, or I don't know. But again, that's why you need audited reports, and that's why you need more transparency for the public. Then this kind of stuff couldn't have gone on. You couldn't have manipulated the markets. You would have had more fair markets. You probably would have had a lot less paper trading, because I think the whole point of the paper trade is to manipulate the markets for various purposes. You wouldn't have all that paper trading on the market if you had more transparency and audits, legitimate audits, and a better regulatory agency. So that's basically a breakdown of what's happened. I think it adds proof to the pile that there's manipulation in the markets. It also adds proof that hopefully the good guys in the government, the ones that actually want to stop this, are doing something about it and bringing more light to the situation. That $1 billion fine on the heels of a $128 million fine at Scotia, that $1 billion fine JPMorgan, should bring a lot of attention to this issue. And you can say alleged, or you can say it was proven, it doesn't matter. The numbers are there, the evidence is there. There's enough there to basically say there was manipulation. I think it's pretty easy to show that, especially when you have former Deutsche Bank traders come out in hearings, and this came out last week, they were admitting to doing it. So they're from other banks admitting to doing it. A lot of evidence showing there's manipulation. When will this end? I don't really know. I do know, at least though, for the futures market, December is going to be very interesting. A lot of open interest in December. I think we'll see a lot of movement in the gold silver price one way or the other. I'm hoping it's to the upside, and I hope we continue the bull market. I think we will, probably, because you're seeing a lot of delivery come in on these thin months like September. We got October coming up. October could be interesting for the precious metals if there are a healthy number of deliveries, and it would fit the pattern of every other month being a healthy number of deliveries. And then again, December being a very healthy month for deliveries ending the year 2020. So we'll look forward to that, and we'll cover this as we continue to go forward. A little bit of housekeeping, guys. I've covered the precious metals markets a lot. Of course, I run goldsilverpros.com, so that's sort of my bailiwick. But I started off writing about the general economy. And one of the things that I want to cover is going to be the cryptocurrencies, and specifically state-sponsored cryptocurrencies. Look for me probably the beginning of next week, but possibly Thursday if I get my research done. I'm going to talk about state-supported cryptocurrencies and how they're going to do it. And we're going to get into our talk of the Great Reset. I think we're getting closer to the Great Reset. So I want to start talking about the methods they're going to implement and how that's going to affect currencies. And we'll tie all that together with gold and silver as well. So until next time, this is Robert Keens with goldsilverpros.com. Hey everyone, not so fast. I have an addendum to this video. Another interesting article comes out in the JPMorgan case. They have admitted guilt, and I don't know how I missed this. I hadn't read Bloomberg today, but there's an article that came out at 9 o'clock this morning in which the JPMorgan traders admitted guilt. So I want to get right to that. JPMorgan admits spoofing by 15 traders, 2 desks, and a record deal, once again by Tom Schoenberg, and adding Matt Robinson this time, came out this morning at 9:18. JPMorgan and Chase admitted wrongdoing and agreed to pay more than $920 million to resolve U.S. authorities' claims of market manipulation involving 2 of the bank's trading desks. So remember, this is not only precious metals, but also treasuries. Wow. So they're going to pay, I think, something $400 million against for the commodities future trading for the precious metals. So it's this paragraph right here. The New York-based lender will pay the biggest monetary penalty ever imposed by the CFTC, including a $436.4 million fine, $311.7 million in restitution, more than $172 million in disgorgement. According to CFTC statement, the CFTC said its order will recognize an offset restitution and disgorgement payments made to the Department of Justice and Securities Exchange Commission. The Justice Department resolution requires that more than $300 million of the penalty be set aside to cover potential victims who could apply for relief through the government. So a lot of people have been asking, where's the money going to go? Where's the $1 billion fine going to go? Well, about more than 300 million is going to potentially go to victims. And I don't know if they're going to have to go to court to get it, or if it's going to be some sort of class action, or if they're just going to, how they're going to identify them, if they're going to go look at the data and the opposite sides of these trades. I have no idea. But at least 300 million, or about 30% of that, a little over 30%, is going to go to victims, which is nice. At least some of that money goes to reimbursing the victims of these trades. Nice statement here. For nearly a decade, a significant number of JPMorgan traders and sales personnel openly disregarded U.S. laws that serve to protect against illegal activity in the marketplace, said Assistant Director in Charge William F. Sweeney of the FBI's New York field office. JPMorgan, in a statement, said it doesn't expect any disruption of service. They did go on to say, and I want to include their statement here as well to be fair, the conduct of the individuals referenced in today's resolutions is unacceptable and they were no longer with the firm, said Daniel Pinto, a co-president of JPMorgan. We appreciate that the considerable resources we've dedicated to internal controls was recognized by the DOJ, including enhancements to compliance policies, surveillance systems, and training programs. So remember when I said, if you had internal controls and you had auditing, it probably would have caught this. Again, I wanted to point that out. Audit, 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 audit. Why their internal auditors didn't find this, I have no idea. But there needs to be auditing on the exchanges themselves, not just at JPMorgan, but on the exchanges to catch this sort of activity. So under the settlement, the bank is required to cooperate with the government's ongoing investigation and prosecutions. That includes making current former employees available for interviews. JPMorgan put at least 4 members of the Treasury's operation on leave starting earlier this year, which I didn't know that at the time. So earlier this year, maybe as this investigation was ongoing, they started putting people on leave, which is interesting. The departures were related to the investigation, according to a person familiar with the matter. The settlement didn't identify the Treasury traders. It's unclear whether the government will pursue any legal action. Okay, there you go. Manipulating treasuries and gold and silver. I showed in the write-up I did the other day where 1 billion wouldn't be enough to offset the price manipulation in gold itself, because gold is $11.3 trillion market, and all the gold, I remind, or most of it, is still above ground, either in people's coffers or in trade. And when you manipulate prices, you affect all 11.3 trillion of that. What percentage of that 11.3 trillion was manipulated? Well, it just depends on how many traders and how people were made. Let's say you were selling jewelry at the time the price was manipulated. Over 10 years, you got less of a price. That affected your price for your jewelry or your bullion, or any other way. Maybe somebody's buying bullion for a retirement fund or whatever. It affected the price. How much of that $11.3 trillion market was affected? That physical gold market was affected by this. We don't really know. It's not just what was on the futures. It was every other transaction during that time. I don't think the billion's enough even to settle that in the gold. And we're not even talking about treasuries. How many trillions of dollars of treasuries exist? Does $1 billion even go close to identifying the misallocations of price and the misstatements of price in that market? I don't think so. So $1 billion still seems light, but hey, at least they've come out and admitted guilt. This is massive. This is going to affect the market in a big way. And hopefully I'll get my article approved. I'm trying to write an article for Seeking Alpha, and they were really hesitant to write this because it was supposedly alleged. And when this came out, I emailed them and said, hey, it's not alleged anymore. They're admitting it. And so now I got to go ahead to write it in Seeking Alpha. So for those of you that see me on Seeking Alpha, hopefully in the next day or two, we'll have that article written. Pay attention to that article at Seeking Alpha, because I do the same thing there that I do here, where I look at the potential for the manipulation on the gold market and the silver market and basically explain why this is not enough. And very interesting information. But again, I can't believe I missed this morning. But again, the admission today, September 29, 2020, the admission that they manipulated the markets. And again, not only precious metals, but the $1 trillion treasury market as well. That's big. That's huge. I'm only talking precious metals. What does that mean for treasuries? What does that mean for people to buy our treasuries like China? What does that mean for people who are buying treasuries to hold for retirement? I don't know. That's an even bigger question. Maybe we'll do a video on that sometime here in the future. In any case, wanted to throw this in at the end of the video. So here's the payoff. They admitted guilt. They're paying $1 billion. Good to see this finally come down after all those years of all of the people in this industry saying there's something going on. Look at the data. Finally, good to see that come to fruition. All the doubters, including people emailing me about this, who didn't believe that they were doing it, well, there, you've got your proof. You've got the admission of guilt, you got the fine, you got everything that you need, basically. So all the data I was showing was basically legitimate. Now, the key question, people have asked me, do you think this is going to stop manipulative trading? No, because there's a lot of other players. Certainly you've had Scotia, which is getting out and closed their trading desk. You have JPMorgan, which I think is going to keep the trading desk open. I think, based upon the release, I don't think they're closing it. They're just some more internal controls and oversight. Whether that works, I don't know. There are a lot of other players in the market. So is that going to stop the manipulation? Probably not. Is it going to bring more visibility to it? Yes. And probably the most important is pointing out again where the CFTC is ineffective regulator. Ineffective, ineffective, ineffective. Shame on you, shame on you, shame on you, CFTC. And shame on you, CME Group. I'm going to send this article to the CME Group. I sent the $1 billion fine for JPMorgan and asked them to prove to me that their data was correct. I'm going to send this admission of guilt through JPMorgan and the spoofing and ask them to walk me through the data and show me it's correct. Of course, they're not going to answer, but I'm going to send it to them because look, now we have the proof. Now we have the smoking gun, the admission, anything that you want. It's all there. So again, I'm going to continue to cover this market, especially leading to massive open interest in December for gold and silver. We're also going to start covering the cryptos because I think the Great Reset is getting closer, and that's not in my words. That's in the words of these supranational agencies like the IMF. And so we'll continue to cover that. So look forward to more cool stuff coming on the channel. Lots of research coming. Appreciate you guys very much. This time, again, until next time, it's Robert Keens with goldsilverpros.com.